Good evening, everyone. Welcome to our Association of Former Students, Texas A&M University Homebuyer Workshop. My name is Jason Maida. Thank you so much for taking time out of your busy schedules on a Tuesday evening to join us. Hopefully you guys are having a great summer, and we're really excited to present this content to you. We're just over the top of the hour. I know we have a lot of people that signed up for tonight's class, so I know they'll be probably joining us. We have folks that are in different time zones. We are recording tonight's class, so if you have to step away from your computer or whatever, we'll definitely have this recorded. And we're going to send out all of the slides to you guys tomorrow. Since you've signed up for tonight's class, we obviously have your email, and we'll make sure that we connect with you with all of the presentation material tonight. All right. Well, this is our quarterly class that we provide to the community, and it's really designed to help provide you with tools and resources to help you on that path towards home ownership. So whether you're looking at buying this year or maybe in the next few years, we want to just pass along some knowledge, resources for you to help you make, which is probably going to be one of the biggest financial decisions. I'm really proud to report that we've got a chance to help some of your fellow alumni in the home buying process, because as we teach these classes, we get a chance to connect with folks that do want to proceed with home ownership, and you'll have that opportunity whenever that time comes for you as well too. So just to learn a little bit more about our organization, so I work with a company called APM, and we're a lending partner of the former students of Texas A&M community. And so when we teach these classes like this, again, we look to provide you these resources, and then whenever that time comes that you need our tools of lending, we're there to help you. Again, my name is Jason, and I'll be your presenter this evening. And as I get a chance to teach this content, I also work directly with our clients in our communities to help support them on some of those tools that they need. Now, here's our talking points for this evening. And before I jump into our talking points, just want to let you know that we are going to take questions as I go through tonight's presentation. So you can either use the Q&A function in Zoom, or you can use the chat feature. I got both windows up right now, so I'll be kind of monitoring some of those questions that come in. We'll also carve out some time at the end of tonight's class to answer any questions that you have left behind. But here's what we're going to talk about tonight. We're going to spend some time looking at the housing market, kind of what's happening right now. Quick poll for the audience, if you have a second, drop in the chat where you're joining us from, or kind of where your goals are to purchase. Maybe just include city and state, because we're going to talk a little bit about markets in just a bit, but we'll spend some time looking at the housing market, also what's happening from an interest rate perspective. Just so you can get a sense of kind of what we're forecasting in terms of interest rates. We're also going to talk a little bit about crediting and building our credit for the future, or maybe looking at some opportunities for credit improvement. And then we're going to kind of look at different loan programs that are available to you as first-time buyers. I see you guys dropping where you're located at in the chat. I appreciate that. A lot of folks from Texas. So we are going to spend some time talking about core programs, but also spend some time looking at the Texas State Affordable Housing Program, which is an awesome tool that can help you out with homeownership as well. We're also going to talk about savings for homeownership. That tends to be one of the bigger challenges for some first-time buyers, is how do I save up enough cash for my home purchase? And then, like I said, we'll talk about first-time home buyer programs available in various states. I know a majority of us are in Texas, but I see some folks, and I think I see ATL, I got Arizona, California. So we'll talk about some other programs available all across the country, but we are considered an expert in first-time home buyer assistance programs. I'll then walk you through the buying process. So after leaving tonight's class, what are my next steps or my action items? So we'll kind of take you through the buying process workflow, and then kind of what we do in terms of a consultation with a client. All right, so that's kind of our plan for this evening. Thanks again for joining us for this journey in tonight's session. Let's first of all talk a little bit about, does buying make sense for me? And, as we think about home ownership, this is probably going to be one of the biggest financial decisions you decide to make, because let's face it, this is, a big undertaking. We're a huge investment for us of time and energy, and of course, money. And so when we think about home ownership, this has an opportunity to be able to create a better fixed housing expense for you, so you don't have to worry about your rent going up every year. There is an opportunity, even though we might be buying in a higher rate environment, to refinance our home at some point in time. So, average interest rate is right around 6.6-ish today, but as rates trend down, we'll have the opportunity to maybe refinance our homes and save ourselves monthly payments. This is an asset that should grow over time. So as that home increases in value, appreciates, as I pay down the balance of my home, that difference is called home equity. And for most of us across the country, that's our number one asset that we have. And it has the opportunity to really change families' lives, create generational wealth for families in real estate. And there still is some tax benefits that come along with home ownership. So potential tax deductibility of interest, also potential tax deductibility when I decide to make home improvement items that might be energy efficient upgrades. So, as we think about home ownership and we want to design a budget, we really want to take a closer look at all those benefits that come out of home ownership, because it's not a fair comparison to look at renting at, say, $2,500 a month to compare it to $2,500 in mortgage payment, because you're getting all those great benefits that come along with home ownership. Now, let's face it, not all of us are ready for home ownership, but as we prepare for home ownership, I think it's important to kind of assess what our budget looks like. And, this is a really helpful tool that you can find on our website. It's called a rent versus buying calculator. And in fact, we're going to put a post up on our social channels here later this week to kind of just show what our community looks like, for our community, what it looks like to compare renting versus what it could look like to buying a house. And so I would encourage our class, if you have some time, maybe dive into our calculator, because ultimately what it does is it says, hey, Jason, if you continue to stay on that path of renting today for the next certain amount of years versus if you compare that side by side with owning, here's what the opportunity looks like for us. So for tonight's class, I just want to walk you through a quick exercise of what we're looking at there. So if we bought, let's say, a $350,000 home and we put 3% down on a conventional loan, maybe a first-time buyer program, we're going to finance, let's say, 97% of that purchase price, or $339,500. We plugged in like an interest rate, an estimated term of my loan. Most of us first-time buyers are going to be doing a 30-year fixed term of our loan. Assumptions around when I buy, so we're assuming sometime in 2025. The cost of what we call mortgage insurance, which we'll examine a little bit later in tonight's class. Homeowners insurance cost, what maybe property taxes look like. For those of us that are thinking of, hey, maybe I want to buy a condominium or a townhouse, there might be HOA expenses, right? And then we factor in things like the income tax level that I'm at on a federal tax basis, the cost of maintaining my house, what it might look like if I'm going to sell my house in the future. And then, of course, one of the bigger items, which is how much is my home going to appreciate over time? So that would be on the home ownership side. And then what does it look like today from a renter standpoint? So if I'm a renter that currently is paying $1,500 a month in rent, and my rent's going to go up maybe 2% on an annualized basis, and I also calculate in renter's insurance cost, that would be my comparison to ownership, right? So when we think about it, in this example, our break-even point, so when it makes sense for someone to buy with these kind of parameters that I shared with you, it probably makes sense for someone to buy in 5 years if they're paying that amount of rent, because that rent is significantly cheaper than what it could look like on the home ownership side. But as I move further, and you can see, you can move this dial a little bit. So if I said, I want to project out what my side by side looks like in 10 years, right? Of owning versus renting. Now at 10 years, I have $42,000 in opportunity. How I get there is the amount of appreciation that I have in my home. So my home's growing in value over 10 years, and my tax deductibility benefits. Now, if I was in a situation where maybe I'm paying a lot less in rent, so let's just calculate that in. Let's say my rent's like $2,500 a month, right? Now you can see my opportunity looks significantly different over 10 years. So, everybody's situation is going to be a little bit different. And of course, the break even is about 2 years here. So I would encourage you, we're going to have this tool available for you after tonight's class. So if you have some time, I would dive into one of these calculators, because I think it's a great launching point to how you're going to consider home ownership. And let's face it, we're in a high cost of living environment today. So when we're thinking about home ownership, we're trying to figure out, is it affordable for me? Is it an attainable financial goal, whether this year or in the years beyond? All right, well, as we think about that goal, let's think about what's the housing market doing. Now, those of you who are in Texas, and I know many of our classmates are, Texas is one of the states it's one of 4 states in the country right now that has one of the higher levels of inventory. So there's more supply out there for buyers. You can see by this graph here, we have 54 days, median days on market. So almost 2 months homes are sitting on the market. Median sales price still holding fairly strong at 356. You can see kind of a little bit of an uptrend here, but there is certainly more inventory on the market. That might be new construction, that might be resale homes. Texas, in addition to Georgia, and I think we have someone from ATL in the class, has another high level of inventory. Florida is another state, and then Colorado is another state that has higher levels of inventory. That higher level of inventory means good news for future buyers, right? Because if I have more supply, then I'm just gonna have better choices for me, and I have more of a competitive climate to hopefully have a better negotiating power with a potential seller. So I think that really bodes well for our first-time home buyers. Now, the other side of the equation is, what are interest rates doing? And so we're going to have a conversation around interest rates now. Before we dive into interest rates, I want to take one of our questions that came in, which is, what is the difference between buying and renting when it comes to credit score? So, credit score is going to lean more into the buying side because we'll talk about credit and the impact to like interest cost, to mortgage insurance, the product selection. Renters, it really is going to be up to the landlord about how low of a credit score, what the minimum credit score they would accept for a potential tenant. All right, thanks for that question. So let's talk about interest rates. That's on the minds of most buyers that are considering home ownership. As I'm out and about in our community today, somebody's asking me about interest rates, and they'll say, "Hey, well, interest rates are really high, right?" And interest rates are high right now. They're higher than historical levels. But I do think there present some opportunity in interest rates today because some of the interest rate levels have pushed some buyers to the sidelines, but those that are financially ready might be able to be in position to buy now, but hopefully maybe refinance down the road. Now, we have a choppy market in interest rates over the last 12 months. It's kind of been a little bit of a wild ride. Just about 2 weeks ago, as of Friday, we had an unexpected lower than expected jobs report that came in, which gave us a nice little positive impact to mortgage interest rates. And we saw the 10-year Treasury kind of drop a little bit. Mortgage interest rates dropped as well. So right now we sit around 6.6% in rate. Now there's a lot of conversation around now, what are the Federal Reserve going to do in the upcoming meetings? Prior to 2 weeks ago, it was about a 30% chance the Federal Reserve is going to cut rates at the September meeting. Right now, I think it's about an 86% chance they're going to cut rates. So, a lot of when we hear conversations about the Federal Reserve cutting rates, we'll have kind of a ripple effect into interest rates in advance of that. But just for you as a consumer, when you hear that the Federal Reserve is going to cut interest rates, it's going to directly impact your credit cards, personal loans, auto financing, things of that nature. It's not going to have a immediate impact on mortgage rates. We'll actually see that in mortgage interest rates before the official announcement comes out. All right. Now, looking back the last 20 years in interest rates, you can see, interest rates cycle, right? And that's why I encourage buyers to think more beyond just today's interest rate, because if I can get in it at a reasonable price today, there is an opportunity for me to save money by refinancing potentially down the road. Now, these gray bars represent some of like the economic crisis, and you can see the housing crisis in 2008, 2009. This gray bar represents the pandemic when rates eventually hit 2.5%. I bring that up because a lot of clients ask me, when are we going to come back to a 2.5% rate world? Probably never going to happen. Hopefully it doesn't, because that means something pretty big has happened across the world. But average interest rates are generally in the high fours, maybe low fives. And, we'll be at that level at some point. I think those that are buying today probably are going to consider refinancing in a couple of years, probably in the 2027 level. There is some talk from some of the Federal Reserve managers that we might get 3 rate cuts from the Federal Reserve this year, which would be a really great opportunity for us in reducing mortgage interest rates. All right. Now, the reason why we're here at this level in terms of elevated interest rates is the Federal Reserve has ratcheted up the federal funds rate to combat inflation, as well as to see eventually how the labor markets react to the changes in the economic environment. And the inflation goal is 2% by the Federal Reserve. We're still higher than that. I think we got an inflation reading that came in today at like 2.6, 2.7%, which is just right about expectations. As inflation comes down, the Federal Reserve will be prompted to hopefully cut rates. And obviously, there's a lot of pressure on the Federal Reserve in this geopolitical environment. Now, I'm getting some questions coming in the chat, and I'm going to kind of keep things moving. What are the downsides of refinancing your home? Does everyone refinance when rates go down? So the downside of refinancing a home, there's the thing, I wouldn't say a downside, but we got to be cautious, because when you refinance, You do have the opportunity of taking that 30-year mortgage and spreading it back over 30 years. So we want to be careful that we're not kind of creating this like it's kind of a hamster wheel effect, right? Where we're refinancing and resetting our loan back over 30 years every time we refinance. One of the tools we have in our tool chest is that we can, let's say, for example, you're paid down 4 years into your mortgage, so you have 26 years remaining. If rates drop, what I would encourage a client to do is don't refinance your loan back over 30 years again. Let's refinance it over 26 years, take the advantage of the lower interest rate, and keep you on that track towards paying off your house in 26 years. Now, some clients may need to stretch that loan back over 30 years ago again because they just need more savings for their mortgage. But I would say the downside of refinance or the thing we got to be cautious is we want to make sure there's a good return on investment in refinancing. So generally, I coach clients to have at least a 1% reduction in interest rate to make sense out of refinancing. And I'll take this other question, and you're welcome for that. A lot of first-time home buyer programs are income-based. Are there programs adjusting for inflation and those that might have an above average income? So great question. We're going to talk about first-time buyer programs in just a bit. So first-time buyer programs, their income limits are based upon the location that you're going to buy in. So depending on what county you're considering, there's maximum income limits. The Texas State Affordable Program has a breakdown, and we can pass along the income links to you. Maybe Ken can drop that in the chat for us. But you can see based upon household size and location what your maximum income is, and of course I can consult with you offline here about that as well too. Most of the first-time buyer programs are going to allow you to make up to 120% of the median income for that respective county. Some states like California, and I think we have one of us joining us from California, you can go up to 150% of the median income. All right. So hopefully that helps. So interest rates are going to be based upon a few criteria like credit score, the type of program, how much I decide to finance, what my down payment looks like. We haven't talked about this yet, but we'll share this with you. A lot of people, especially in your online searches, will come to me and say, hey, Jason, should I buy points for my loan? Not really something I'd recommend in today's market because there's about a break-even point of about 40 years, 3 to 4 years in buying points. Essentially what buying points is you're paying additional funds out of pocket to bring down your interest rate. And so to our conversation we just had around refinancing, if I'm going to turn around and refinance in 2027, it wouldn't make a lot of sense for me to invest a lot of money into buying down my interest rate. And then the term of my loan can also influence what my interest rate looks like. As we get a chance to connect with in our follow-up consultations with clients from classes, and we're going to figure out what the right program looks like for you and ultimately the design for you in your home buying plan. All right, now part of that conversation centers around credit, and because credit can impact our borrowing cost ultimately. So coming to a class like this, we want to give you some areas of opportunity in your credit score that for you to kind of walk away from today's class. Now, every loan program does have minimum credit scores, so I thought I would share that with our class here. You can see those on screen. When we think about credit, there are 3 different models to credit scoring. There's a auto finance model, so if you're deciding to purchase a car, you're going to have a different score for that. There's the credit card model, and by the way, that credit card model is used for most monitoring services like Credit Karma or any other tools you subscribe to. And there's also a mortgage model that we use to evaluate financing options. So of course, we're going to use the financing model for lending purposes. So there's 3 different agencies to scoring. There's Equifax, Experian, and TransUnion. We take the middle score of all 3 agencies. So if my highest score is 760, for example, my lowest score is 720, my middle score is 740. The middle score is what we use for qualifying purposes for our lending options. Now, if I have a partner that's at 720, 680, and 660. Well, the lowest middle score between the 2 of us is 680. So that's what we use to determine eligibility for our qualifying. All right, so that's kind of what we look at. We get that question a lot. We always look at the lowest middle credit score. That also holds true. Let's say, for example, if you want to apply on your own, but you have a cosigner, and maybe you're having a cosigner added to your financing because maybe your credit score is lower. It doesn't replace that lower credit score, if that makes sense. We're always looking at the lowest credit score between all borrowers, including cosigners, co-applicants, whatever the case may be. Now, when we think about challenges on our credit, let's say we've had a late payment or we were over limit on a card, it's usually going to impact us in the most 12 to 24 months from the date of the event. So if I was late on my Discover card in October of 24, it's still probably hurting my credit score, but as I get further and further away from that late payment, I'm probably going to see some improvement in my credit score. Now, this matrix here will help kind of guide you in terms of how long will it stay with me on my credit report. Now, again, the most recent 12 to 24 months, say the late payment is where it's going to impact my score. The image on my credit report will last at least 7 years. Now, as I mentioned earlier, there are different models to scoring. We use the mortgage lending or mortgage model for FICO scoring. So I thought I would share with our class like how that score is weighted for different areas. I would encourage class tonight is that when you kind of walk away from tonight's class, maybe examine your own credit file, and we can certainly help you with that as well. But you can kind of take a look at maybe where are my areas of opportunity today. And so it starts first with like length of credit, and that's just going to be more about seasoning in my credit. So how long I've had credit is going to, so the longer my credit score has been around or the more mature my credit file is, higher my credit score is going to be. If I've recently opened up new credit, I've had new inquiries or hard inquiries on my credit, that's going to impact my credit score. So we really want to avoid that. We don't want to open a bunch of accounts, especially in that 12-month window of time. Now, one of our unique ways that we design options for our clients is we always start with a soft credit check because a soft credit check doesn't impact our client's credit score. Many lenders will do a hard inquiry automatically. We don't do that because many of our first-time buyers, especially folks that have come to our classes, are not ready to buy right now. So we want to give you your choices and options in buying without having to impact your score. So, and that's obviously 20% of the weighting. So it is quite important. Amount owed is the next weighting. That's the second to highest weighting in the credit score, and that has to do with your revolving accounts. You're looking at your balances versus your credit limits. The way we look at that is we're looking at aggregate totals. So if I have, $15,000 in credit limits that are available to me, but I've charged up $10,000 of those balances, so right now I'm sitting at roughly 80% utilization of credit, maybe 70%. So that's probably hurting my score a little bit. Now, as I pay down my credit card debt, I want my first level of improvement is 50% of that $15,000 credit limit. So I want to get my balances to $7,500. The next level of improvement is 30%, which would be $4,500. And then optimal or ideal is 10% or better. And you can kind of see that displayed here. So if you're going to manage your credit card debt down, here's what I would recommend doing. Take a look at your recent billing statement. There is two dates that are pretty important for you. One is the billing statement or cycle date. The other is the due date. The billing statement captures all of your credit activity in that previous 30 days. So my recommendation to our class tonight is try to pay down those bills before they hit the cycle date, because when they hit the cycle date, that's when the credit card issuer sends all the information out to the agencies, the credit card or the credit reporting agencies. So if I can pay those down before the end of the billing cycle date, then I have a much lower balance, better utilization, and then I improve my credit score. So try to go and switch things up a little bit versus paying on the due date. Try to pay by the end of the billing cycle date. Last component is payment history. So we're looking at, how we paid on our bills. I mentioned the example of, a Discover card that I had late in October. That would be a 30-day late, probably impacting my score in the most recent 12 months. But as I move further away from the date of the event, I should see improvement in my credit score. Now, the more severe my credit late is, if it's a 90-day late, it's probably having a bigger impact to my credit score. All right, now as we think about credit, one of the types of accounts that always comes up in my conversations with clients is student loans, right? So many of us are having student loan debt that's coming back online for payment. And so I wanted to kind of give you some perspective on the lending side about how we view student loan debt. So if you're currently in active repayment, you might have an income-based repayment program. So let's say in this example, I have $75,000 in student loan debt and I'm paying on a reduced plan at $250 per month. Well, from a lending perspective, we can use that right away to qualify you. So that's absolutely allowed. Now, if you're on a deferment right now or you're in forbearance, so you don't have an active repayment status, then in lending, we have to use a default number to qualify you for your financing. Because the reason why we have to do that, all programs take a look at expenses versus income. So whether you're doing an FHA loan where it will take 0.5% of those total balances in student loans, which would be like 375, or you're doing a conventional loan that looks at 1% of the balances, which would have a payment of 750. We have to plug that into the expense versus income analysis. And we're going to talk more about that in our class later on. But I think one of our takeaways for you in the student loan section is, and because this gets a little confusing, people see that they only have a zero payment reporting on their credit report. So they assume the lender only takes zero. The only way we can take a zero payment if that's truly your payment, because maybe you're on an income-based program that has just a no payment option for you. Otherwise, we're going to have to assess either 0.5% or 1% of the balances. Okay. Any questions about student loans? I get that. I get a lot of like conversations in our classes around that, but any questions I can help answer or providing clarity around student loans? All right. Okay, we'll keep it moving. If you do, just feel free to drop that in the chat. So let's talk a little bit about loan programs. And the reason why we have guidelines like student loans is because they're all part of the qualifying for different types of loan programs. Many of these programs I have on screen, you guys have probably seen them before, or kind of like maybe done some searches that include choices like this. So I want to give you kind of a high level look at each one of these programs. We'll start with a conventional loan, which is essentially the Fannie Mae Freddie Mac loan. For us as first-time buyers, we have a minimum down payment of 3%. Now, there's a maximum loan amount that stretches all the way up to 806,500. That is what we call the conforming loan limit for the United States. Now, for some of us, I don't see anybody that was in a high cost of living area that put their location in the chat, but there are high cost of living areas. So if you're looking to purchase in, let's say Arlington, Virginia, for example, you can go up to like $1.2 million in amount finance, but the minimum down payment jumps from 3% to 5% for that home purchase. All right. Now, the next product is an FHA loan. That's a federally insured loan. FHA stands for the Federal Housing Administration. That is a minimum down payment of 3.5% with a minimum credit score of 580. And then the maximum loan amount that you see on screen here will vary by the county that you're going to buy in. Now, I want to tie together both the FHA and the USDA program because both of those products are government insured loans. USDA stands for the United States Department of Agriculture, as you might have suspected. It is a product that is designed to support those that want to buy in more rural areas, like let's say you're out of like a metropolitan area. There's two qualifiers with USDA. There's location and income limit by household. And it does have a minimum credit score of 620. You can see this maximum loan amount. We just picked a county in the Texas market, but that will change based upon where you want to purchase. Now, a couple months ago, the government, U.S. government, the FHFA has made some changes in eligibility around these government insured products, which requires you to be a permanent resident to have access to either one of these programs. Unfortunately, those changes were made. That does impact buyers' eligibility. So you cannot be a non-permanent resident to access these programs. Now, you can access through the conventional loan, so Fannie Mae and Freddie Mac, but unfortunately not on the FHA or USDA government insured products. The jumbo loan product allows those that need a little bit more funding power to purchase with the jumbo loan, but it is a 10 to 15% down payment, a little bit of higher credit score requirements. We don't see that too often from first-time buyers. And then for our veterans that have eligibility for the VA home loan product, it's a zero down payment option, lower credit score requirement for more flexibility in qualifying for the veteran. And there really is no maximum loan amount for the VA product. And so, you can do a zero down payment option essentially for the veterans, just a lot more flexibility to encourage opportunities in home ownership for the veteran. All right, we're going to talk about, I saw a question around PMI in the chat. I know Ken picked that up too, but we're going to go into PMI right now. And we're going to kind of dispel maybe some of the myths around PMI and maybe give a little bit more clarity on what PMI looks like. Now, for conventional loans, there's PMI, which stands for private mortgage insurance. And for government insured loans like FHA, there's MIP, which is mortgage insurance premium. So they have different mechanics to these programs. PMI, and this is one of our questions in the chat, if you put at least 20% down, there is no private mortgage insurance. When we put less than 20% down, then we do have PMI, which is scaled by down payment, amount financed, and then what my loan amount looks like. Now, one of the benefits if you do take out PMI on a conventional home loan is that you do have a cancellation option. When you reach 22 to 20% equity and have 2 years in your loan, you can apply to have your mortgage insurance completely canceled. Okay, so that's one of our big benefits around the conventional home loan. Now, if you've already started doing some calculations online, maybe on some of the popular housing sites, you're probably going to get a miscalculation when it comes to the cost of mortgage insurance. So it's really not terrible in terms of cost when you look at the numbers. Because, like, for example, if you finance, let's say $300,000 and you had a 740 credit score with the 3% down payment, the mortgage insurance is $92 a month. So not as probably as expensive as you've seen in some calculations online. Now, the higher I can raise my credit score, the more I can put down, the lesser my costs are going to be for my mortgage insurance. So that's kind of what the conventional side looks like. Now, what PMI is, essentially, it's providing insurance to the lender against default by the buyer. And so you think about it from this perspective, it's basically risk insurance for the lender. So if something happened, they would be protected because, the less you put down, the lower your credit score is, that could make that potential financing a little bit riskier. FHA is the government insured product, right? So a little bit of a different situation there where we're looking at two forms of mortgage insurance. Upfront mortgage insurance, which is 1.75% of my finance cost, and then 0.55% from a monthly perspective, and then we divide that by 12. And so with FHA mortgage insurance, there is no cancellation option. So when I think about FHA as a vehicle for our clients, I'm not looking at this as the loan that I'm going to keep for 30 years. More than likely, our clients are going to try to refinance in a couple years because FHA has more leniency around credit score, around maybe debt to income ratio. So we're going to use this as a launching pad into homeownership, but it is a little bit more expensive than what we see on the conventional side. So we take that same loan amount of $300,000. We're going to have upfront mortgage insurance at $5,250 plus the monthly mortgage insurance. So it clearly is a lot more expensive than conventional, but it is another entry point to homeownership for our buyers that maybe wouldn't exist otherwise. So now I had a question that came in the chat, which is, do you have the formula for PMI? I do have the formula for PMI, but it's not just a straight linear number. It's going to be, it varies based upon those factors. So if you were looking at this factor here, it's 0.37% essentially of a $300,000 loan amount, and then we divide that by 12. So it's almost like when we think about this calculations for PMI, it's going to almost look like auto insurance. So we're going to look at that credit score, the down payment, the amount financed, and then we plug it into various calculators and it spits back what our premium is going to be. Another question is, can you do lump sum payments after you have set an interest rate? I heard that can offset the PMI and duration. So you can do, the types of loans we're talking about are very kind of simple products because they allow full principal payments. So, let's say, for example, my mortgage payment is $2,000 a month, but I'm going to round up to $2,500 a month. I can pay $2,500 a month. Anything I pay beyond that minimum payment of $2,000 goes right to my principal balance. So essentially, $500 is going to my principal balance every month that I make that payment. And you can pay off these loans at any time. There's no prepayment penalty for doing that either. Now, as you pay down your loan quicker, then you're going to have a better opportunity to cancel mortgage insurance when that time arrives. All right. Thanks for those questions. That's awesome. I know some of you got into the session a little bit late, and we're glad you got here. I just want to remind everyone we are recording tonight's class. So if you missed the first third, for example, of our class tonight, we're going to send you out a recorded version, so not to worry. And we're going to send out all the slides from tonight as well, too. Let's talk a little bit about income for qualifying. And before we dive into that topic, I do want to just pass along some general documentation that we ask for from buyers as they start building their home buying plan. So you can see that list noted here. It's generally the last 2 years of history when it comes to like income generated, and then recent pay stub history. So let's talk a little bit about employment. And as we evaluate eligibility for clients, we do look at the last 2 years of work and/or education history. And I say the and/or education because there's a little bit of a misconception. In fact, I was just talking to a buyer earlier today that thought they had to be on their job for X amount of years. But the way it works is, as long as I can show my 2-year work and/or educational history, I can use my income right away to qualify me for a mortgage. So if I just graduated from A&M in the fall and I just started my new job the first of the year, I could still be eligible to use my income to qualify me for a mortgage today. Now, that does assume that I have a full-time position or a base salary position, so a full-time hourly or base salary position. Now, if I'm in a position where I have variable compensation, so let's say I work for Google, right? And I've only been at Google for a year. Well, we can, in that case, we only can count the base salary for that person working at Google today. But once they reach 2 years on the job, then I can include an average of their 2 years of cash bonuses. And some of our clients in tech, they do get RSUs. Potentially, once they have 2 years, we can use restricted stock to count towards their income as well too. So kind of the takeaway here is that if you have fixed income, we can use that income right away. If you have variable compensation, then we do have to show that you've been on your job for 2 years. Now, if I have a scenario where I'm working multiple employers, in that scenario, I also have to show that I've been on both jobs for 2 years simultaneously. If I'm self-employed, I do have to show that I have 2 years of self-employed tax returns filed with the IRS in order to use that to count towards my qualifying. All right. Other scenarios that come up for us too, we have sometimes clients who have a full-time job, but they also drive for Uber or Lyft on the weekends and they want to count that side income. We can do that as long as they can show both jobs have been working for the last 2 years. All right. Um, and then one thing just in terms of variable compensation too, this question comes up a lot. If we have overtime income, in fact, I was meeting with someone this morning, they haven't been on their job 2 years, so they do have a big chunk of overtime that they generate in their annual income. But until they reach 2 years in that employer with that employer, I can't count that overtime into the calculation. So we generally take variable income and we average it over 2 years to determine kind of consistency and sustainability for qualifying in a mortgage. All right. I had a few questions that dropped in here, so I'm just going to tackle these, and we're going to kind of move over to a debt to income ratio calculation part of our conversation tonight. Question is, I'm currently a renter. I'm not sure if I want to stay in San Antonio for more than 3 years. How long do you advise owning your home to make it worth the selling cost if I need to move in a few years? So it's a great question. I mean, I think ultimately we're gonna have to look at what our financial investment looks like for you, for in terms of how much cash you're gonna put down, where you're at from a housing perspective today. So if you're in a very minimal rent situation and you're trying to make the numbers work for home ownership, we'll have to see what the break-even point looks like. And I would encourage you to use our rent versus buy calculator. I'll certainly help you through that too during a consultation, which by the way is a free service we provide to you as well too, just to help you kind of understand your options. And then another question came in. I think Ken helped out with it. I'm gonna just kind of like tag on a little bit. So the question was, if I mentioned about the principal payments, but if I include anything past my mortgage payment, would it go towards the principal? What about the escrow payments? So that $2,000 example I was giving you would be assuming your taxes and your insurance in your payments. So that would be anything I pay above and beyond. Now, taxes get evaluated every year. So your mortgage servicer could reset your escrow impound account for a higher amount, depending on what that looks like. So if my taxes today are $5,000 a year and they jump to $6,000 a year next year, my $1,000 difference is going to be factored into my new payment. So that could change things. And then we're going to talk about assets in just a bit, but I think this is an asset question. Is there a set amount limit that you must hold in the bank account to be used for the mortgage payment and closing costs? So I'm going to take that question in our asset section because we're going to talk about savings plans. But there is an amount that I would recommend, which will include your down payment and your closing costs. So I'll tackle that in just a second. Let's kind of finish off our income section. So I want to talk about expenses versus income. We call that debt to income ratio. Now, when we think about this calculation, we're looking at the housing expense that we're projecting to have with our new mortgage. We're looking at our existing expenses like personal loans, credit cards, any type of debt that we're servicing right now, right? So from a housing perspective, we're using the principal interest, taxes and insurance, private mortgage insurance if we're electing to put less than 20% down. If I'm going to buy like I said, a condo or a townhouse, I'll bake that into the calculation. Generally, we don't want to see expenses exceed more than 45 to 50% of your pre-tax income. That's a big stretch number, right? Now, for most clients, they feel pretty comfortable if their expenses are not exceeding more than 33 to 36%. That's what we would kind of look at as excellent. Now, some of our clients in high cost of living markets just don't really have much of a choice because of affordability challenges. So they might be closer to the 42, 45 range. But everybody's scenario and kind of tolerance of expenses to income looks a little bit different. Here's an example of how we look at that calculation. So we have the principal and interest, taxes and insurance, PMI, and then we put an HOA here. But let's say that assumed projected household budget is $2,500. This person is paying an additional $500 in expenses, and they make $8,500 a month. So essentially, this $3,000 is occupying 35.3% of their pre-tax income. Now, keep in mind, this is a pre-tax calculation. So, we're looking at this as a metric towards qualifying. It's not necessarily something we're going to determine what affordability looks like. Those are conversations that we're going to have as we design your plan for you around homeownership. All right, so this is our last topic before we talk about workflow and buying a house tonight. And that was kind of prompted also by one of our questions in the chat to talk a little bit about savings for homeownership. So you've heard a little bit about programs and some of the minimum down payments. When we look at those minimum down payments, let's say a conventional loan, the minimum is 3%. So if you're going to buy, let's say, a $3,000 home, 3% down payment would be $9,000. But there's also something called closing costs and prepaid items to buy your house. Now, closing costs are expenses like lender cost, attorney cost, depending on the state you're in, or title and escrow fees, some of the local county charges. Those are all part of closing costs. Those are negotiable, by the way, with your seller that you present an offer to. And then there's prepaid items, things like you have to prepay interest for the month that you're going to buy in, the annual premium for your homeowner's insurance, and some of the prorated amounts for taxes on your home. So all of those get kind of bundled together in my total cash out of pocket. So if we were going to kind of use that example again of a $300,000 home, if I need $9,000 for my down payment, I would recommend a buyer budgeting for 2 to 3% of their purchase price for those closing costs and those prepaid items. So I would say probably realistically $15,000 total in that example to as high as maybe $18,000 total out of pocket. All right. Now, and that can be a challenge for some of our first-time buyers. So we're going to spend some time talking about assistance programs in just a bit. When we verify things like the assets we have saved up, these are the general sources where we can validate those assets. Of course, cash accounts like checking and savings accounts are fine. Retirement accounts can be used, but we generally recommend if you're dipping into retirement accounts or you're going into 401ks or brokerage accounts, I should say, talk to your financial or investment advisor just to make sure that's a good sound move for you. Now, just to bounce back to cash accounts, cash per se cannot be used in real estate. So we have to paper trail every asset used in a home purchase. And generally, those assets need to be seasoned for at least 60 days. Now, gift funds can also be used in a home purchase. That's where a family member has contributed resources for you in your home purchase. Now, on that side of it, there are no seasoning requirements for gift funds. That's essentially where maybe mother or father, or a combination of both, or an uncle has contributed towards your home purchase. There is no limitation on how much gift funds can be received by a buyer. Now, as we prepare for homeownership, I wanted to give you a really simple approach to savings because it is one of the bigger challenges for homeowners. And so when we look at, let's say, what we're at today, let's say in this example, we're going to look at someone that's paying $1,500 in rent today. Let's say, we're good right now with what we're paying in rent, but we just lack a lot of savings. So, and after they consult with us, let's say their projected mortgage payment looks like $3,000 a month, which their debt to income ratio can handle. I would tell that client as kind of a coaching for savings is let's start making our rent payments today like we're almost paying that mortgage payment, right? Today. So what that would mean is as I transfer money to my landlord, $1,500 a month, I create that habit or that discipline to take an additional $1,500 that essentially is making up my $3,000 mortgage payment, and let's transfer that to my savings account on a monthly basis. And so, as we develop that habit, it's creating more savings, of course, for us. And by the end of 6 months, we have $9,000. By the end of the year, it's like $18,000. And not only develops a higher level of savings, we're not also factoring in high yield savings accounts that are going to gain some interest, but it creates that kind of I guess comfort level, if you will, that when I transition to homeownership, it's not really such a big payment shock for me because I've been saving $3,000 a month. And that's really a simple way of kind of generating savings, but again, creating that discipline or habit of making that mortgage payment. Now, there are assistance programs available. We are an approved lender in Texas and other states on first-time homebuyer programs. For those of you that are in Texas, which I think is a good chunk of our class, I'm going to spend some time talking about the Texas State Affordable Program now. Now, for those of you in, I think I saw Georgia represented, California, there are other first-time buyer programs. Those in California, Cal HFA, which is the California Housing Finance Agency program. We can kind of talk offline on that one. And then for Georgia, we do also have some incentives for first-time buyers as well too. Now in Texas, there's the Texas State Affordable Program, which provides up to 5% in down payment assistance. What's nice about these programs with the Texas State Affordable Program is they have a forgivable component. So at the end of 3 years, the assistance is forgiven, which is a really great opportunity for our clients. So it's completely deferred payment and it's forgiven. It's allotted on FHA loans and conventional loans. There are a kind of a HEROES program as well in Texas, which allows military, first responders, teachers, and others to have extra incentives for their financing under these programs. Now, one of the cool things in Texas, which does not happen in most states that we operate in right now, is there's a thing called a mortgage credit certificate. Currently, that mortgage credit certificate provides a 15% of the interest that you pay on your mortgage back to you as a tax credit to lower your tax liability and hopefully improve your refund. But let's say, for example, you spent $10,000 in mortgage interest, you would get a tax credit of $1,500 towards your federal tax return liability. So that's a really cool option. It used to be 20%. They reduced it back down to 15%, but still a great opportunity nonetheless. There is national programs like Freddie Mac has some incentives for low-income housing. And then internally within APM, we have two national-based programs. There's the Pathway Program, DPA, and there's we call it the Click and Close Program. Those are both available on FHA, 3.5% and 5% assistance options. That's just a nationally branded product. But again, for those of you, depending on which state you're in, we do have state-specific first-time buyer programs available for you as well. All right, we're gonna now, before we go into the workflow of buying a house and kind of what happens next after your class, any questions on any assistance programs I can help answer for our class? You guys have been great with your questions too, by the way. So I'm sure if you had questions, you guys would be dropping those in there. So let's go ahead and talk about workflow and buying a house, right? And a lot of our clients ask, what comes next after a class? How do I get prepared for home ownership? So I want to kind of take you through just our simple 6-step buying process. After you leave class tonight, we would encourage you to get connected with us for a consultation. You're going to get some more follow-up information on that after tonight's class tomorrow. But that is kind of where we build the framework for you of home buying. You don't have to feel like you have to buy this year. Maybe it's not even until next year, but we want to at least get you positioned. So if this is a goal that you have set for yourself, that we can help provide the right tools around you. Now, a consultation is a comprehensive review for you in your finances. Again, we'd only do a soft credit check, and it's a free service we provide to our community. Once we build that home buying plan for you, then we can issue what we call as a pre-approval. The pre-approval, whenever your timing is right, will allow you to go out and start shopping for homes. Now, it's good for 60 days, but we can always recertify that at any time so you don't have to feel rushed to go out and buy a house. Okay, so that's step one. Step two takes us to going out and looking for homes. That's the home search. You might have been even looking at homes just before today's class online. So that usually starts online. And then you'll probably eventually start working with a trusted realtor in your market. Now, we do have preferred realtor resources that we can recommend to you if you do need that as well. But realtors should be an expert in the communities that you're kind of searching in, understand, the characteristics in a homeland and community that you're looking for. And then generally there are buyer broker agreements that you'll be signing for a realtor to represent you. Now, it may take some time to find that right home for you, but when you do, Then you can present an offer to a seller, of course, through your realtor. That offer gets submitted to a seller and they take it under consideration. There might be some negotiations back and forth, but if that offer gets accepted, then we move to the next milestone, which is called step 3 of entering escrow. So that means you have a ratified contract with the seller and buyer that have coming together for the home purchase. Now we'll get advised of that same day of the agreement, and then you'll get a call from me saying, "Congratulations, you did it. You got your offer accepted." So let's kind of walk you through next steps, and then let's get you scheduled for your follow-up video session, so we can make sure that we have the financing designed properly for you. Now, you do also have some action items as a buyer, like making an earnest money deposit, which is depending on the market you're going to buy in, but it's usually 1 to 2% of your purchase price, but it does count towards your total out-of-pocket expense. So the things that we talked about, like down payment, closing costs, prepaid items, that earnest money deposit will count towards that as a credit. Now, in most parts of the country, there is what we call as a contingency as part of the contract. The timelines of those contingencies vary based upon where I'm going to buy in the country, but ultimately allows me to do my research on the property, my investigative work, things like home inspections or roof inspections, maybe checking out the pool or the septic or the water, whatever the case may be, right? And to make sure that my deposit while I'm doing that research is completely protected. So that's what a contingency does. Also allows us as your lender to get your appraisal done of your house, get your loan approved, and then your realtor will generally organize those inspections that you want to have done on the property. Once those inspections are done too, those are also opportunities for negotiations with sellers to say, "Hey, we need to get this X fixed here. Maybe it's a HVAC unit or whatever the case may be." That is an opportunity for you to renegotiate, credits towards those closing costs or prepaid items that we talk about, or maybe even to renegotiate your purchase price. Now, an interesting statistic right now, because of how much inventory we're starting to see stack up across the country, 44% of all transactions being done across the country have some type of seller concession right now, meaning the sellers have credited towards the buyer's closing costs and prepaid items. So that also makes it kind of a favorable market for a lot of our buyers at the same time too. Step 4 is going to bring us to kind of more of the back end administrative items of the lending process. We call that processing and underwriting. We're verifying employment, assets. We are going to be looking at the rate market too, because we want to make sure we lock in the lowest available rate, because interest rates, as we talked about earlier, they do cycle, but in the business trading day, they cycle by the minute. So we really want to watch the market carefully for you to seize the lowest opportunity. And then also our underwriter is going to complete that review at step 4. And that'll take us to step 5. So we've now issued a loan approval. You're probably at the end of your contingency period, so you can sign off on your contingencies as long as you feel good about the property. And then we're going to start kind of putting the final touches on loan disclosures. Now, throughout the process, you get disclosures sent to you electronically, but when we get to step 5, we're going to deliver to you a final closing disclosure. As a buyer, it gives you a 3-day cooling off period before you get to the very final stages of the home closing process. Now, on that day, you're going to be meeting with an attorney, maybe an escrow officer, or just a regular public notary. That is the one time you do have to sign documents in person with a notary or one of those other representatives. Also on that day, you'll be wiring in your final funds for closing. That money gets then compiled with our lending funds that we're going to wire to the escrow team for you as well. That money then gets situated to who gets what. And then they record documents with the local county recorder's office. They'll record what we call as a grant deed to transfer ownership. And then they record a deed for the home financing, which is your security agreement for your loan. And so once we get confirmed on those recordings happening, then we get a chance to make our favorite call of the day, which is say, "Hey, congratulations, you did it. Now you're a new homeowner." And it's such a huge celebration because, obviously it's a big financial milestone for our clients. I love the text messages I get from clients showing a picture of their family getting the keys to their house. In fact, we just put one up on our socials today. It's a really cool family, Alexis and Jim, who got the keys to their home. And those are really where that's really what it's all about, honestly. It starts in this classwork like this, and then it kind of transitions to the real-time buying. But so many great success stories of our buyers out there across the markets. Now, our relationships with our clients don't stop there. We stay connected with our clients through different tools that we have, especially to evaluate refinance options, like through our Rate Watch system, track your home equity through Homebot system. And then we're doing annual check-ins with our clients just to see kind of getting a pulse of where they're at financially, if we can help them in any way. All right. So that's kind of what the buying process and our aftercare looks like. Now, as we're wrapping up class, I know we got a few minutes before the top of the hour. Just want to give you some of the get started information. So if you think you'd like to kind of build your own personal home buying plan, here's our get started information here. Really simple online application, uploading the documents that we shared during our income section, and then you can schedule your free consultation. And I meet with all of our clients on video or phone if you prefer, but we seem like we get a lot more accomplished on video, so we can kind of screen share and show you different options that could work for you. Again, there is no pressure to buy a home right away when you meet with us. We just want to make sure that we set up financing for you that can help you accomplish your financial goals. And then this is kind of what that consultation service looks like. We're doing a lot of the same conversations we have in classwork, but we're kind of tailoring it to your own personal finances and your needs in homeownership. All right, and then last resource I want to point out to you is some of our technology. So mobile is really important to us because we're all on the go these days. And so you can start the application process right from mobile. You can follow the progress of your application, and then you can also run calculators on various properties that you see, different payment scenarios, all on mobile. We really embrace technology, but we don't replace obviously the human touch of a major financial decision like this. We have other tools that are available to you that are AI driven that can really give you response time, really good response times on replies. But our team is always available on call, text, email, just to make sure that you get what you need to make a good financial decision. Last thing I want to point out to you is in our partnership with the Association of Former Students, we also not only just provide these classes 4 times a year, but there's also a credit towards your closing costs. So we reduce down our closing costs to make financing more affordable for you. And we have all the tools to help you obtain home buying successfully. And we are the 9th largest lender in the country, so we do have a lot of great resources available to you. We have this class also through other partnerships too throughout the country. So if you've enjoyed tonight's class, if you have friends, family, maybe some coworkers that might enjoy tonight's content, feel free to share some of the links with them. We'll have other classes available throughout the year, and we are looking at building a online, or not an online, but an in-person class that we're going to also teach virtually in College Station. Hopefully next month. I know we're still trying to arrange that with our leadership team at the association, but stay tuned for that. So if you're in the College Station area and you want to see us in person, we'll be out there too as well. This is all my contact information, so feel free to drop me a message and I'll get back to you with anything I can help you with. And of course, there's all links for our socials. We are going to have this class, like I said, it's recorded. It'll be up on our YouTube channel tomorrow, and then Ken from our team will also get you out all the presentation material tomorrow as well. And I have some questions kind of piling up in the Q&A and chat, so I'm going to answer those now, and then we'll make sure that we get you guys out of here. All right. So the first question was, as a military veteran, if you use the non-VA loan option as a first-time buyer, are you allowed to use the VA loan if you wanted to go and get a second home on this second purchase? So sounds like you purchased not using your VA the first time. So you should, as long as your certificate of eligibility has the entitlement, you should be able to purchase the second time with your VA. So even though you didn't use it the first time, you still have it available the second time. In fact, we have a veteran in California right now that purchased with VA last year and is looking to purchase again with VA. The VA does have options where you don't necessarily have to sell your current house in order to purchase again with VA. Now, it might be advantageous for them to sell because then they have better equity to put down the next place, but VA does allow multiple time use. All right. Thank you for that question. And some first-time buyer programs will also work with VA as well too. Texas State Affordable Program does have a VA option, and then discounts for veterans as well too. All right. Thank you for that question. I want to make sure I didn't miss anything else. I think we got most of it. We'll get you those income limits out too for you guys, for those of you in Texas. I missed Arizona too. Arizona, we do have first-time buyer programs out there as well. We are, of course, licensed in Arizona as well too. A lot of great tools out in Arizona as well. Arizona is another advantageous market as well too, for first-time buyers with the amount of supply out there. A lot of great negotiating happening in that state too. All right. Okay, well, I think we did it. I appreciate everyone's being very engaged and interactive in tonight's class. Hopefully you found this information insightful and provide a little bit more clarity on maybe some financial goals around home ownership. Look forward to hopefully getting a chance to meet with each of you to build your own home buying plan and get that design work done for you. So we'll get all this material out to you tomorrow, and I look forward to seeing you soon. Have a good night.